Are you tired of seeing your hard-earned money vanish to taxes year after year? In today's episode, we're diving into game-changing tax strategies that you'll want to know, not just to reduce your tax burden, but to create predictable income, secure your financial independence, and build a lasting legacy for your family. Peter Culver, co-founder of Wealth Thrive, brings over 40 years of experience in wealth management, tax planning, and generational wealth building. If you're ready to make smarter investments and protect your business success for future generations, this episode is for you.
Welcome to Biz Help for You, the show that saves you the expensive learning curve by providing advice from industry experts in every facet of the entrepreneurial journey. Too many small businesses collapse. According to the U.S. Census Bureau, 20% fail within their first year, and less than 35% make it to their 10th anniversary. The goal of this podcast is to change that statistic. So if you're interested in learning more to be a successful entrepreneur, tune in today.
So, Peter, welcome to the show.
Thank you, Candy. Nice to be here.
I'm glad to have you here today, too. And I'm sure people are going to be interested to hear the topic that we are going to be discussing today. Who doesn't want to plan for the future and save for future generations and save tax dollars? So I would love for you, of course, just maybe to first touch on what are some of the biggest tax mistakes that you see entrepreneurs making and how can they avoid them?
Sure. So, the biggest mistake is they pay too much in taxes. And the reason often is that we make a distinction in the work we do between what we call tax preparers. Those are CPAs. It's a very necessary function. You've got to file your taxes. You need to file them on time. You need to put the right numbers in the boxes and add them up right. But most CPAs don't think of their job as really thinking out of the box and trying to teach the client how they can make the numbers smaller. So we get a lot of requests in our business. Oh, can you look over my historic tax returns and see if my CPA made any mistakes? The answer is we don't usually find mistakes. It's a mechanical exercise. What's going on is there isn't in the tax return strategies that the client could take advantage of. So maybe just conceptually, I'll unpack that and we could talk about a few strategies that we use. So in the work that we do, depending on the client, there are potentially 3 different areas where you can save taxes. Income taxes, right? So I make X, and everybody knows I can deduct some mortgage interest maybe, and now maybe a little bit more because of the one big beautiful bill, or maybe I make some charitable contributions. If I have really bad medical expenses, I can deduct some of those. So that's a way to reduce your gross income down to a lower taxable number. In our world, the entrepreneurial world, where a lot of clients own businesses and then sell the businesses, they're going to have a capital gain on the sale of their business, roughly equal to the difference between what they paid for it, plus whatever improvements they put in it, minus whatever depreciation they took from the sale price. And for a lot of our clients who are sort of bootstrapping type entrepreneurs, that number can be a big number. So that's the second area we focus on. If you're going to sell an asset, and it could be a business, it could be a piece of real estate, it could be some of your stocks and bonds, what are things that you can do to reduce that tax? In today's world, a smaller group of our clients have the potential for paying the estate tax. So that's a pretty small universe these days, because as a result of the one big beautiful bill, an individual can have $15 million worth of assets and a married couple can have $30 million worth of assets and not pay any estate tax. So you got to be pretty well off. It's a nice problem to have, but so I would say most of our work is around that year by year by year. How can we help clients reduce their income tax and when and if they have a capital gain transaction. Uh, so that's a long-winded answer to the question you asked, which is, I think the mistake most business owners make is they don't educate themselves, or someone doesn't educate them about the opportunities, which are, again, depending upon their specific situation, those can be quite, I mean, we help people sometimes cut their tax bill in half, sometimes more than that. So there's significant opportunities out there. And I think that's sort of part of our role is education and then implementation, but it's got to start with the education. What I sometimes call, what's the menu that you could choose from to, soften your tax blow?
Mm-hmm. So generally, there's probably things they're missing that they don't even know they're missing, and maybe their CPA doesn't know they're missing,
Correct.
in terms
All
of
the
getting
time.
those deductions. Mm-hmm.
So
Right.
maybe if it's helpful, I can just give a few examples just to whet people's
Sure.
appetite. And I would say, so there's some relatively simple things people might do. They're not insignificant in dollar terms. They're not the big needle movers, but I'll describe a couple of them. So there's a provision in the tax code, which is officially known as the dwelling unit rental rule. If I own a business, I can rent my home, and that's a broad definition. I can really rent a residence, and that could be a home, a second home, a boat, an RV. I can rent that to my business for business meetings.
Mm-hmm.
Now, what the rule says is if I do that, the income that I would receive from the business to rent my home is tax-free income up to 14 days a year. So the way the math, so some people will say, well, that's great, but nobody's going to rent my house. It's a dump, or I don't, whatever it is. But not people have, the way the rule works is it says, if I didn't have a house to rent to have a business meeting, I'd have to have that meeting at a hotel, at a conference center, at a WeWork center, whatever it is. And the cost of it would be, pick a number. There's a range across the country, but it literally is, if you have breakfast and snacks and lunch and all the audio visual and all of that, it might be $1,500, $2,000, $2,500 a day, depending upon how many people you have. So it's still deductible by the company. The company just decided to have the meeting at Candy's house rather than at the Marriott, right? So neutral to the company. But as long as, and that's part of what we do with our clients, you have to have two things. One, an appraisal that shows that the value that you had the company pay for the house is reasonable in the area that you live in. So look, it's going to be a little bit higher if you live in Beverly Hills. It might be a little bit cheaper in my opinion, the much lovelier part of the country that you live in, but probably the going rate is a little bit less, right, for that. Right. But that income, so let's just say it's $2,000 a day times 14 days. That's $28,000 a year of tax-free income. So that's not nothing. That's and the only other thing that you really need to do, and again, we make this, if it were our clients, we make the whole thing turnkey. We give them the forms. We show them how to get the appraisal. The thing that's very important in many, many areas of the tax world is you have to keep adequate records. You can't just I had a meeting at the, you want to have an agenda and minutes. Today's world, it's very easy to do because you would just turn your computer on while the meeting's going on and record the meeting. So that's a nice little one. Another one that's similar to that is what we call PTK, Paul, Tom, Kate, pay the kids. So there's a provision in the tax codes which says you can pay your kids. I think right now, I'm actually not sure whether the One Big Beautiful Bill increased it. I think it's $14,700 a year per kid. So your business can hire a kid. They got to do real work. And, you can't hire a 6-month-old to like run the computer or something like that. It's got to be real. But under the tax code, again, if it's legitimate work, that money is deductible by the company because they're paying for something, hopefully of value. But up to that annual limit per person, it's not income to either the parent or the kid. So you could see if you, and most people would take that money and put it in a savings account for a kid or add it to their five. We're not usually giving that money to the kid. And you could argue that if done the right way, that's a good learning experience for a kid, right? Get some work experience, see what it's like to show up on time. And, so those are two kind of, but you could see if you did both of those, let's say, in my example, maybe $28,000 for dwelling unit rental tax-free. Let's say you had 2 kids. Let's just round the 14.7 up to 15. That's 30. So, in your family budget, that's $55,000 of new income coming in for whatever you want to do with it that you would not pay taxes on. So you'd be surprised. And those literally just come right out of the tax code. There's nothing particularly creative or edgy about those. And to your point, not only is it surprising how many clients haven't heard of that, it's equally surprising how many CPAs don't even know about some of those things. So that's where the education piece comes in. Now, there's some other much bigger needle movers, and there are many, but I'll give 2 examples. So a technique, there's slight variations of it that we use a lot, is having clients invest in solar projects. So when the Inflation Reduction Act came out about 4 or 5 years ago, the so-called infrastructure bill, it had incentives for solar. And basically, there are 3 benefits from solar. 1 is not a tax benefit, 2 are a tax benefit. So if you have solar panels, if you own them, you can sell the power that they generate back to the power grid. And in fact, the power grid has to buy the energy from you. We're required to do that. So there's a little bit of cash flow if you own some solar panels, not a lot. The 2 tax benefits are A, depreciation. If people are familiar on the call, depreciation's a deduction, right? So it fits in general into the same category as medical expenses or charitable expenses or mortgage. It reduces my top line income down to my taxable income. When the Inflation Reduction Act came out, it set as a time period for depreciation a 6-year schedule. That's a pretty favorable schedule in general over many other types of assets, which are longer than that. A nice benefit of the One Big Beautiful Bill is, and it's not just in the solar area, it's in a bunch of other areas, is it reinstituted for solar what's called 100% bonus depreciation. So now I don't have to stretch that out over 6 years. I can take it all in the first year. So that's helpful. And depending upon how much money you invest, you invest $200,000 in some solar panels and you get $200,000 deduction right up front. That can be significant. The real benefit of solar is it also qualifies for tax credits. So if people on the call can sort of picture the tax return, if you have a vision, the first page is from gross income down to taxable income. You put in your W-2 wages up there at the top, dividends and interest, others business income. Then you knock off your deductions and you get to a number usually at the bottom of page 1, which is taxable income. Then you turn the page over. You put that number again at the top of page 2 and it says, look at the tax table on whatever page it is and it'll tell you how much you owe. When you get to that point, below that, it's only about half of that, the second page, there are places where you can put in tax credits. The reason tax credits are so valuable is they go dollar for dollar against tax, right? So a deduction is good. It's very valuable. But even if you lived in the worst tax state in America, California, where income taxes are basically 50% in the highest bracket, a deduction chops your tax down by 50%, but that's it. If you have a tax credit, it just knocks the tax down dollar for dollar. The silver lining in solar is, this is only applicable to solar, not to other kinds of tax credits, is if you can't use all of the tax credits that you're entitled to in a year, and there's some rules which are the government's not completely stupid and they don't want you to totally wipe out your tax liability using tax credits. There's kind of a ceiling of about 70 to 75%. So even though based on your purchase of solar, you might qualify for more tax credits than you can use, you can't use them all in the current year. The solar legislation says I can carry those tax credits backwards up to 3 years. And what that essentially means as a practical matter, if you have those excess tax credits, you can go back up to 3 years and use the excess tax credits to amend your tax return for the prior years and get refunds. So some people would say that's the nirvana of tax strategy. Not only do I pay less this year, but I get the government to send me checks. So that's an example of a type of strategy we use, and it's depending, that's an example. A lot of tax strategies are what we call tax equity strategies. That's kind of the term in the business. And what that refers to is your CPA calls you up and says, Candy, you have to write a check for $150,000 to the IRS. And you go, ouch. And then if you don't know anything about the stuff that we're talking about, you write a check to 150. What tax equity says is don't give the 150 or all of the 150 to the government. Basically, quote unquote, invest it, allocate it to tax strategies where instead of sending all that money to the government, you get to keep some of the money and use it for what you want. So there is an out of pocket. I'd like to think of it as an investment. It's really an investment in yourself because it's enabling you not to pay all the taxes to the government. The second one that we use a lot, there's several variations of it, are charitable deductions. And there's some special rules. So if I write a check to charity or I give an appreciated stock to charity, there are some rules around that. Where the creative work with charitable comes in is giving assets to charity, not cash, not securities, but giving an asset to charity. What's normally referred to as the donation of a tangible asset. And at any given time, there are opportunities in the marketplace for a variety of reasons whereby I can buy an asset for a substantial discount to its appraised value and then donate that asset to charity. So I'll use some math. And I'm going to use a big number just because it's easier to do the math. I don't know if that's applicable to the people on the call or not. But let's say someone made $1 million a year. Some of the charitable donations will let you get a deduction of up to 60% of your income. So let's just keep it super simple and said, I got a W-2 from my employer for $1 million. God bless. I might be able to get a deduction of up to $600,000. So leaving aside tax brackets and all that kind of stuff, you can see simple math, that's reducing my taxes by a heck of a lot. But back to the tax equity concept, I can probably acquire that $600,000 deduction for about 20 to 25% of $600,000 or $125,000 to $150,000. So sometimes that's referred to as a leveraged charitable deduction. There's no leverage with cash or securities because there's no range of value. It is what it is. But sometimes for supply and demand reasons, sometimes for actually the philanthropic desire of the seller of the asset that's going to sell it to you, and sometimes people who are developing new products, they see using the strategy as a way to raise capital to expand their business. And so they're actually willing to kind of sell their product at a discount to grow market share. So those are just two examples. For business owners on the call, it's in the top of my mind because I was just talking to another business owner about it. Sort of like with solar, up until the One Big Beautiful Bill, research and development expenditures also had to be depreciated over a period of time. And basically, the One Big Beautiful Bill has brought back what it used to be a while ago, again, 100% bonus depreciation. Now, there's a whole bunch of rules about what qualifies as research and development, what you can count for what people do. But, for any kind of business that does software, invents processes, things like that, sort of intellectual capital, often that's a very significant part of their budget. And so being able, again, those are tax credits. So they go dollar for dollar, and it's not exactly the same as solar, but this reinstitution of bonus depreciation for R&D also lets, in certain cases, the taxpayer go back a couple of years on the theory that if they'd had this bonus depreciation last year, they could have deducted more. So they'll go back and amend their tax return and get some money back. So those are some examples. And, and we're not intending to beat up on CPAs or anything like that, not by any means, because they're a key part of the process. But I think those are kinds of things that probably most people's CPA isn't calling them up on the phone and asking them about. And that's a lot of what we do. We do a lot of webinars, live presentations, sort of like we're doing today a little bit, just to educate people about their opportunities.
Well, I wanted to also move to like the legacy planning and wealth building for, generational wealth that people can build now and pass along too. So I would love to find out from you, what do you feel are some of like those key things that people should be doing? Entrepreneurs obviously have a business too, but what should entrepreneurs be doing to build that wealth that they can then, of course, have a legacy and pass that on to future generations?
Yeah, so I think there are two parts to that. One is the dollars and cents part, and one is maybe what I'll call the family dynamics part. All right. So I think one thing, and look, again, in that area too, the less money I pay in taxes before I pass along my wealth to my family, then there's more to pass along. Now, then we have to get smart about how we're going to pass it along. So simplistically, if I have a balance sheet of assets and I die and I own all those assets, those are potentially subject to the estate tax. The estate tax is applicable in all across the country at the federal level, and many states have an state estate tax. Not all, but many. And so part of the thought process there is, if I think I'm getting close, and again, it's a crazy big number, but that number's changed a lot. But let's say I was a single person and I was worth $20 million. So I could exclude $15 million from estate tax, but I'd have to pay estate tax on the other 5 from 15 to 20. And depending upon what state you live in, that tax is going to be 40 to 50% of the value. Well, all estate taxes essentially driven by ownership. If I own the asset, it's on my balance sheet, I'm going to pay taxes on it. So there are a host of strategies by which a business owner, any human being really, can move assets out of their name. Most people would not move assets out of their name directly to their heirs because they might be worried that the heirs would squander them, or they'd be subject to liability and things like that. So typically what's happening is high level, one of two things. They're putting those assets in trusts for the benefit of their spouse or other heirs. Something they can always do is give some of those assets to charity. If you, in your will, say that, let's use my example, guy worth 20 million, the exemption's 15, he's exposed to 5. If he said that 15, that's plenty for my family, I'm giving the other 5 to pick your favorite charity, that would just come right off the top and would not be subject to estate tax. Now, a little nuance, sort of, I don't know, a little wicket that you can sometimes navigate is that although legal ownership breeds taxation, there are ways to put in place structures where you still have some rights to control and enjoy the assets, even though you don't own them anymore. So there's a structure that we use a lot where a husband and wife each give assets to trust, but they're sort of cross trust. The husband sets up a trust for the wife sets up a trust for the husband. You put assets in those, and if it's done properly, there are ways, even though those assets are outside the estate, the husband and or the wife can access the assets during their lifetime. So that's a little bit. Now, again, that dynamic right now is applicable to crazy rich people because that's a big number, right? 15 million.
Right.
The other thing worth talking about is, and it's very applicable to business owners or self-made people, which is that the statistics around how long a fortune that a first generation creates lasts into successive generations is really depressing. It's something like if a business owner starts a business and grows it to significance, in I think something like 70% of the cases, it's more or less gone at the end of the second generation and maybe almost totally gone at the end of the third generation. So, well, that's potentially applicable to people of any level of wealth, right? Because I think if you're going to leave some amount of your desire is to leave some amount of money to your heirs, you want that to be perpetuated. So sometimes people would say, well, the reason the wealth went away is they didn't get good tax advice or they had a bad investment manager. There's a whole cottage industry that studied the issue that sometimes is referred to as shirt sleeves to shirt sleeves in 3 generations. So the first generation rolled up their sleeves, they got to work, they made a lot of money. The second generation enjoyed the wealth, and by the third generation, it's gone, and so they have to roll up their sleeves again. Well, the people have there's some wonderful books about that for people that are interested in that topic, but it really turns out that the reason that happens isn't things like bad investment management or bad tax management. They could make it worse. But it's really much more about education and training inside the family and communication inside the family. It's bad family dynamics that causes the erosion of wealth more than bad investment management or bad tax management. And so there are a whole host of things that people have found over the years to sort of be successful in stopping that trend of the erosion of value. So some wonderful, if people are interested, we have a whole reading. There's all kinds of interesting, and again, I think kids at almost any level would benefit from the right training and preparation to manage whatever assets they're lucky enough to have.
Right. Well, I know we're barely scratching the surface of the conversation we can have, but I know we are coming close to the end of the time we have together. So I wanted to ask, do you have an offer that you would like to extend to our listeners? And if people want more information from you, how can they contact you?
Yeah, so let's do the second one. A couple of things. I would say there's a lot of information, more information about what we talked about that's accessible through our website. So that's just wealththrive.com, www.wealththrive.com. And there are videos on there and, position papers and things like that. So that could be helpful. Happy for anybody who thought one of the topics we talked about was interesting to either email me, it's fine, directly, or call me. My email address is just Peter at wealththrive.com. And there may be even a place I don't ever go on our website, but there may be some place on there where you can get me directly. They could call me. My phone number is 917-697-4156. An offer I would make would be, I have to think about the best. Let me describe what the offer is. I've got to think technically how to get it to people. But sometimes people will say, hey, that tax stuff sounds interesting. Can you give me an estimate of, based on my basic situation, how much money I might be able to save in taxes? So we send them a link, which basically, when they click on the link, opens up a very, very short questionnaire. What state do you live in? Do you file single, head of household, married, filing jointly? What's your income? Do you think it's going to be this year? What was it a few previous years? Just a few basic data points. And we have a pretty sophisticated computer matrix that information goes into. And we can give you a pretty darn close thing. So maybe the thing to do is email me, Peter at wealththrive.com, and just say, send tax profile, or I think that's what we call it, is the tax profile. And happy to give you that initial. And I would say one thing that people might find interesting. So in our company, we do a webinar, we call it a Thrive Talk, once a month on a variety of wealth management type topics. About 4 times every year, those webinars are about some tax-related issue. They're all recorded. I think the recordings are on the website. They're transcribed. That's on the website. There's a wonderful little piece on the website, which is sort of, maybe that's where you got your title from, but we call it 23 game-changing tax strategies that your CPA never told you about. So, and they're just those, it's just a quick little fact sheet, but there's a lot of resource, both about saving money on taxes and this family dynamics type issue, I guess we'd call it, on the website. And then they could reach back out, and happy to, explore on a one-on-one basis with people any additional questions they might have.
Perfect. Well, thank you for being a guest on my show, Peter. I appreciate, the conversation. And
yeah.
To you, the listener, too, if you enjoyed today's topic and you want to hear additional information, you can find exclusive content in the show notes. Thank you for tuning in today. Would you please share this episode with those you know and leave a review on your favorite platform? And if you find our show informative, would you consider being a financial sponsor to help me continue my mission to educate business owners? A link is located in the episode description, and no amount is too small. I'd really appreciate your support. If you are interested in connecting with our guest and receiving the offer they had to share, a link to our resource page is in the show notes. Finally, if you have any bookkeeping or payroll needs, reach out to us at 310-534-5577 or contact@abandp.com. My team and I are eager to assist you. Until next time, have a great day.
Thank you for listening to Biz Help for You. Please join your host, Candy Messer, again next time. Have a terrific day.